AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I'm Tony Mendez. Gordon is out today, taking a summertime vacation. You're always welcome to call the show, 800-516-1220, 800-516-1220. You can be my co-host today, or you can email the show, Tony or Gordon at bayarealoansource.com. Mortgage rates continue to be something that everyone's paying attention to, 5.7% on the 30-year fixed, according to Freddie Mac weekly survey. It's actually down this week, going back a couple weeks. So we've actually seen refinance volume spike a little bit based on these slightly lower rates. And it doesn't seem like it, but if you are out there kind of, and this is what I recommend a lot of people, if they have to refinance, if they're going to refinance, you don't have to lock right away. So when you see the rates ebb and flow, then you pull the trigger. And that's probably what this is, because that's where they really measure it. They measure the locking of these rates. 15-year at 4.83% and the 5-year ARM at 4.5. So again, we see that big difference between the 5-year ARM and the 30-year fixed, 1.2% as of right now. Last week it was 1.3 or 1.4. We've seen it up to 1.5%. So we've actually had quite a few conversations with people about whether or not they should use an ARM, especially on a purchase. Now, qualifying for a loan and getting a rate for a loan, those are two different things. So especially if you're getting an ARM, because certain ARMs you have to qualify at the rate, what they call the start rate, or you qualify what they call the fully indexed rate, or you qualify at the start rate plus 2. So there's a lot of different ways that they qualify, but it still doesn't change your payment. It's just the qualifying. So a lot of people are considering ARMs now because of the advantage of that lower interest rate. And yes, you can save a ton of money. I think I have my paperwork right here from a little podcast that I did on a $500,000 loan, 1.4% it was, the difference last week. So that's on a $500,000 loan, that's $420 a month, or about $5,000 a year, or $25,000 a year over a 5-year period. So you can save $25,000 over a period of time. And that's what's being sold to you. What you're not being sold to you is what happens afterwards. And you have to be really careful about this. So they have these things called caps. You know, your first cap, then you have your yearly caps, and then your lifetime cap. And that's how much your rate can change on those three events. And in some cases, if you see indexes, and that's really what the ARM rate is tied to, you can see those indexes go up considerably, which they have just recently. And they probably will go up a little bit more. But that doesn't mean we know what's going to happen 5 years from now. So you have to kind of prepare when you get into an ARM, whether it's a 3, 5, 7, or 10-year ARM. It's fixed for that period of time. What do you do after that fixed period is over? So you have to prepare for that. Are you going to refinance? Are you going to sell the house? Are you going to turn it into a rental? There's so many things that can change based on what you think is going to happen until it actually happens. And that's why ARMs feel riskier, because you don't know what's going to happen. A lot of people opt towards that 30-year fixed, even though the rate's 1.2 today, higher than that 30-year fixed. So, since over the ARM. So if you do consider an ARM, do your research, look at the indexes, look at the history. The United States is one of the few countries in the world that actually have 30-year fixed because they have ARMs. ARMs are kind of indicative of what's going on in the economy. So if the ARM rates go up, that means the economy is doing better and you're doing better and you're able to pay it. And then as the economy kind of changes the direction, then the rate goes down, you're making less money. So it kind of ebbs and flows with the economy. And that's really kind of what it's supposed to do. But right now, a lot of people use it for short-term financing or just to, manage a property or that debt for a period of time. But I can tell you, if I was selling a house in 5 years, there's no way I'd get a 30-year fixed. And we run across a lot of people who still actually get a 30-year fixed, even though they're going to sell their property. You're giving away money. There's another tool a lot of people do is they take an ARM payment, but they pay the 30-year fixed payment. So they have the lower rate, but they're paying the 30-year fixed payment. So that every month they're putting a little bit extra to the principal. And then your balance is even lower. So you've saved not only that, in this example, $25,000, you've saved a little bit more on the principal. And then if you have to refinance, you have a little bit of room in there to roll in some costs, maybe even buy it down or get another ARM. So there are some advantages to an ARM. A lot of people in our industry on our side, the professional side, use ARMs because they generally save them money. And they're in the industry, they do a loan, and it makes sense. So it doesn't mean you should do one. It means that you should at least consider one, but look at all of the advantages and disadvantages. Don't just focus on the advantages. So you have to be really careful. So yes, we did see refinance volume increase a little bit. If you're looking at a refinance, that's what we do. It's what a lot of people do. Do your research. Rates are going to be all over the place. We've seen a half a point difference in rate between two lenders for the same exact product. And that means that the consumer is also going to see that as well. That's why we believe brokers are better. You're going to start hearing that more and more because especially as you see these variations in rates as you shop, because we have an advantage that a big bank doesn't have. They have to use their own products, where a broker uses multiple lenders' products. They're called wholesale lenders. They do not have a retail branch that you can walk into. Most of them don't. 95% of them don't. And brokers use them. They're designed especially for brokers. And brokers also tend to attract more talented people who've been in the business a longer time. And there's more money in it. That's one of the reasons why they attract it. And they pass that along to the clients that they have. And that's you. And you get the benefit of them being able to shop for you. There's a lot of other rules out there that protect you as a consumer that we have now that we didn't have back pre-Great Recession. So out of Dodd-Frank came, the anti-steering rule, which prohibits a loan officer from steering you towards a loan that makes them more money, right? They have to give you the options. Now, if you're not getting options when you go to a lender, doesn't matter if it's a bank or not, you have to get options. You have to get options not on products, but also on what can you do to fix your credit score? Is your credit score 720? What happens if I get to a 740? It's so easy to do what they call a what-if scenario. Oh, if I paid $2,000 off, by the way, it's money you owe anyway, on a credit card, how does that affect my credit score? Does it go up? If it goes up enough, you get a break on your rate. So you'd be paying money that you owe anyway, so why not do it, get your credit score up? That's just one of the options. Options on buying down the rate, or getting an ARM, or looking at, and later in this show we're going to talk about buy downs and points. Buy downs, there's something called a buy down, like on a 2-1 buy down. You can actually have a start rate for the first year 2 points lower. So if today's the rate is 5.7, you'd get it at 3.7 for the first year. And then the next year is 4.7, and then it goes back to 5.7. Yeah, you can do that. There's ways to do that. A lot of people who are purchasing do that. We're going to talk about that a little bit later in the show. So as a consumer, you need to get options. Absolutely. If you are not getting options, move on. They're not going to be offended. They're in the business to try to earn your business, and if they don't do it right, then move on. That's plain and simple. We've been doing this for many years, over 20 years plus. I've been in financing for over 20 years plus. If you were not getting options from us, then move on. I'm not going to be offended because I didn't do my job. So that's the nature of the business. But brokers tend to get more talented people. They have more options for people, for buyers, whether it's VA, FHA, USDA, Fannie Mae, Freddie Mac, jumbo, especially jumbo. Jumbo's all over the place. You thought there was a big difference in just the regular Fannie Mae and Freddie Mac rate of a half a point. You can see much larger differences in the jumbo arena. Some lenders are a point difference for the same exact scenario. $1 million loan, 740 score. You have reserves, you have this, and if you're stuck with that lender and that's who you chosen to go to, you didn't do your job in shopping. So yeah, there's a little bit that's on you as well to go out there and be the educated consumer. It's incredibly important that And with especially with all of the data that's out there, I mean, you have so much resources out there. Yeah, a lot of it feels like it's an ad, and yeah, it is. Most of the time, it's an ad. But there's a lot of really good resources out there. You can email me, Tony@BayAreaLoanSource.com. I can give you some great resources to go and search. Some of them, I like the MortgageProfessor.com. He's a great guy out there. He even gives you some of the insiders on brokers, and we kind of follow those rules. And then I always search, through the Zillows and the Redfins, and, really careful about ads, especially stuff that comes to you in the mail, especially nowadays. You're not getting a lot of stuff going, hey, oh, by the way, you can get a lower rate than what you have. Those mails, that correspondence has ended. Nobody's sending you anything saying, oh, by the way, you can get a higher rate. They're only looking for purchases. But if you are looking to refinance, definitely do some research, especially, if it's an investment as well. There's a big, big difference in investment, cash out, multi-units, huge differences in rate from lender to lender. Be very careful about who you end up with. You don't have to, when it comes to money, you don't have to be loyal to somebody just because you've been around for a while. It's all about money. They know it. They know it's about money, and if you go somewhere else, they didn't do their job, and they need to fix their position to attract more clients. And in all reality, that's what capitalism is. If they're behind the ball, they're behind their game, and they haven't adapted to what's going on in the industry right now, you shouldn't be going to them. It's like going to a law firm where the guy's all sitting around smoking cigars and thinking that they're saying, oh, I made so much money, puff puff. That's not the way it is anymore. There's a lot of there's ways to be interactive with your transaction. There's ways to everything's electronic, except in California where you still have to sit down and sign. We don't have a remote signing yet, but we will eventually. I think there's like 17 or 20 states that do. I still feel comfortable sitting in front of somebody, and especially when they're signing, if they want to. COVID kind of put a curve in it, but it also advanced a lot of the technology that goes into making it very easy for you. Yeah, there's still some compliance, and there's still a lot of disclosures, a lot of things to sign, but you can do and be careful. There's a lot of companies that say, oh, it's so easy to do a transaction. Do it on the phone. Boom, 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 boom. You're done. You're pre-approved. That still doesn't do it in my book. Okay, I'm not old school. I'm new school, but that still doesn't do it for me. You have to be really careful about that. You need somebody to really walk you through in those options, the programs. How do you fix your credit? What are points? What is an ARM? Instead of you choosing it. No offense, but sometimes there is maybe a better option. And if you're not exploring what that better option might be, then I think you are leaving some money on the table. Most cases, maybe not, but it's worth trying. We'll come back after this break. You're always welcome to shoot an email to us, Tony@BayAreaLoanSource.com. You can call the show, 800-516-1220, 800-516-1220. Podcasts and our videos. That's Facebook, YouTube, LinkedIn, all Bay Area Loan Source. We'll come back after this break.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez. A lot of people that are out there buying today are looking at these higher interest rates. So 8 months ago, they were 2 to 3% lower. That's eaten into their debt ratio or their buying power by 5 to 10%. We've seen 5 to 10% debt ratio loss over the on several of these transactions that we've done, and people have to scramble to get co-signers. That's something that we should talk about at some point is co-signers. A lot more people are going to need co-signers, and what are the implications of that? So that same priced house last year costs more today. Essentially, you're qualifying for less. A lot of people having to get not pre-approved, but re-approved for their loan. Sellers are also feeling this. How do we keep our house, the sale of our house, that price where it is? Let's say it's a $900,000 house. How do we keep that there when we have buyers that are losing buying power? Well, some of the things that we've seen people do is, you're going to start seeing more seller credits. right? You're going to see this. This is just going to happen. You're going to start seeing more days in the market, which is something else we're going to talk about today. And you're going to see buyers and sellers just really getting into it. It's going to be more balanced. So one of the things you want to do is to get a lower rate, right? So let's say you're getting a seller credit. That seller credit can be used to pay your closing costs. Let's say you're getting a $10,000 credit. Let's take a $500,000 loan. Let's say that the seller's a little bit more agreeable about giving you a $10,000 credit. That's about 2 points. Okay. So that credit, instead of using it towards your closing costs, you have some other options. You can buy points. Points are, 1 point is 1% of your loan amount. So on a $500,000 loan, that's $5,000. So if you were given $10,000, you can buy the loan down, or buy the rate down, that is, by 2 points. Okay. Those 2 points, in this case, I looked it up. It's about 0.75% lower in rate. And on a $500,000 loan, that's about $233 lower each month. That means the seller paid you, or paid to lower your payment by $233 a month for the life of the loan. The break even on that is 43 months, just under 4 years. Every month after that is more money in your pocket. So they paid for your lower rate. You save $233 a month for 43 months, or you could have taken that money and put it towards your closing costs. But every month after that is more money in your pocket. So that's the long-term scenario. And this doesn't make sense for about 50% of the buyers out there. You don't actually, you need to keep the loan for at least that 43 months in this case. You don't know if rates are going to come down enough for you to refinance. You may sell or refinance for like a cash out. Who knows what you're going to do, but that's about 50% of us that happen. Otherwise, it would have made more sense for you to put that money towards the closing costs, and would simply rather have that money now. It's whether you want the money now or you want it later. So the other thing you can do with that $10,000 concession, this is hypothetical, is to do what they call a buy down. This is the short-term answer. Using the same example where the seller is giving you about $10,000, exactly $10,000 in seller credit. They want to keep the price the same. They're saying, no, I'm not lowering my price, but I'll give you a $10,000 credit. This is something we're going to start seeing. And just like the previous example, the buy down works to lower your rate. The buy down works only for 1 to 3 years. So you can choose 1, 2, or 3. So let's take the 2-year option. It's called a 2-1 buy down. This means the first year your rate will be 2% lower, and then the next year after that, the second year, will be 1% lower. Let's take 5.5. Right now it's 5.7, but 5.5 is an interest rate. So the first year, your rate will be 3.5%. That payment is $2,245. That's $593 lower. This is a yearly difference of $7,100. The second year, the rate is 1% lower, or 4.5%. That payment is $2,533, or $305 lower, or $3,600 that year. And in the third year, it goes back to the 30-year payment at 5.5%. So the total of these 2 years savings, which is roughly $10,795, you can go back to the seller and say, look, I'll buy it at $900,000, but I need a $10,795 credit. And then you can enjoy your lower payment for the next 2 years. Now, again, you don't have to use that money towards a buy down. You don't have to use it towards points. You can put it towards closing costs instead. That's the immediate savings. The long-term savings is when you do it to buy down what they call points. That on a 30-year fixed or an ARM, it doesn't matter what you use, but you're buying down the rate forever until you pay off that loan. And then you have what they call the short-term savings, which is the 1 to 3 year buy down. So these are some tools that a lot of people are considering, including using an ARM. You don't have to do a buy down. Let's say the seller is not giving you any credits. You can just get an ARM anyway. We see typically a 1 to 1.5% lower in rate. And we talked about this earlier on the 5-year ARM. It's kind of like the buy down, but without the money, because on the buy down, a lot of people are expecting rates to fluctuate. They're expecting to have those short-term savings and then refinance into a lower rate down the road. Maybe they improve their credit. Maybe the value goes up. They have more loan to value or better loan to value. Maybe rates just drop, and maybe it's a combination of everything, and they get a really good drop. So that's what we're going to see for the next couple of years. Is we're going to see rates fluctuate a lot. So a lot of people might consider putting it towards closing costs, because if you do refinance and you've put that money in, you don't recapture it. So you want to you want to put that money into the closing costs so you get that immediate savings. So these are some of the scenarios that we've been seeing with a lot of the clients recently that are looking to buy is buy downs, points, and arms, and then towards closing costs. But there's no doubt that we're going to see more and more people, sellers that is, giving concessions, I believe, to keep their prices up. We're also going to see a lot of sellers do what they call seller financing. Oh, you can't get the extra 10%? We'll finance it for you. This is something that's a little bit foreign to a lot of people. They haven't had to do this for years, but it is something that was very common back in the day. I'm saying pre-Great Recession, where a lot of people would simply say, you know what, I'll go ahead and finance that $100,000 for you for a period of time, and then they'll pick an interest rate. Usually it was 6%, and it could be higher now, and then they put a lien on your property, and there you go. And then you simply just pay them. It's like a second loan. So we're going to see a little bit more flexibility that way. The thing that you have to be careful of is if it's a desirable property, and I think we're straying a little bit off the topic here, that you're still going to see at asking or over asking. This is where you have to really work with your realtor and make sure that you're not getting too aggressive. And you start getting into the days on the market. Oh, this property's been on the market for 70 days. Everything's selling in 20 days. Why is this one 100 days or 70 days? I'm going to offer lower. There's other ways to negotiate. I like the seller contribution towards your closing costs, or you can use those towards points to help you. And I'd probably go for the short-term version, maybe the buy down. I don't know if I'd go for points because I don't think I'd keep the loan that long. I'm in the industry. I'd probably get an ARM, or maybe get an ARM and buy points, and then have that nice payment for 5 years, just to kind of get it back to even that status quo to what it was and what I really expected getting into the property. So I think more and more people are going to be engaging in this, which means more and more people are going to need resources. You're welcome to shoot us an email, Tony@BayAreaLoanSource.com. That's Tony@BayAreaLoanSource.com. You can also check out our Facebook, LinkedIn, and YouTube. That's all Bay Area Loan Source. And you can always call the show if you want to get your questions on the air, 800-516-1220. That's 800-516-1220. We'll be right back after this break.
Got a question? Run it past these guys. 800-516-1220. It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez. Thanks for all of the calls and the emails. So investors have always been looking for products to help them buy and leverage properties. During COVID, many of these products were wiped clean from the industry. They just went away. But they have come back in abundance, not all at once, but they've been coming back. And investors are very active with these. In fact, a couple of weeks ago, we talked about how active investors are. They are even more active today as they're starting to kind of they're drooling over this new inventory that they believe is going to be hitting the market, and maybe a little bit of breaks here and there, especially as they see rents up. So these are the products that are pretty standard in business. You have your standard Fannie Mae and Freddie Mac deals. That's, everybody can access those for the most part. Private money, especially for properties that don't meet the appraisal conditions, or they don't have income and they just have a lot of money. Renovation loans like the Fannie Mae Home Style, non-qualified mortgage products that have higher debt ratios, higher cash out, and lower credit score requirements for multi-units as well, and higher loan to values, and even the bank statement loans. And these are the types of loans that make up about 80% of the market for investors. The standard conventional being the most popular, that Fannie Mae and Freddie Mac. But most of these loans require what they call full doc income, meaning that no matter what, you have to make income to cover the debt, which includes the rents on the property. So it's investor, i.e. non-owner property. So other than private money, none of these loans take into account many of the factors that investors encounter. They assume everything is going to be fine, and that many investors, they just don't qualify. But most investors know that's not true. Stuff happens. They have vacancies, repairs, they have accounting issues like on their taxes, on their Schedule E, and so on. And that one especially, the accounting issues. Believe it or not, a lot of investors don't record a lot of the income. Some just don't do it right. They have a Schedule E, or they have an LLC, and it just doesn't pan out right. And, so what do these investors do? Well, in comes what they call the DSCR loan. It stands for Debt Service Coverage Ratio Loan. It's exactly what it sounds like. As long as your rents cover the PITI, it covers it, you qualify for the loan regardless of your personal income. Here's how it works. Let's take a 4-unit building. Rents for each unit are $1,500. That's $6,000 gross in rents. As long as the PITI is less than that $6,000, the house qualifies. PITI stands for principal, interest, tax, and insurance. There's even DSCR loans that allow 75% calculations, which means that your rents can be lower than your actual PITI. Yeah, your rate's a little bit higher, but you still qualify, and your LTV is a little bit lower, and you need higher credit score. So here's where this type of loan makes a difference. Your personal income can be zero. Your home qualifies you, and it's kind of the way that commercial loans work. Number two, your units don't have to be rented. You can actually fix up a unit and then come right out with just a lease agreement, and there you go. You don't have to have it recorded back on your tax returns because they're not getting tax returns, and you don't have to report income on the prior tax returns, which is something else. So they're still rate sensitive, things like credit score, number of units, cash out or no cash out, loan to value. So these are great loans for investors as one of the tools if you don't fit into their standard products, the renovation loan standard, Fannie Mae, Freddie Mac, private money, and so on. If you have any questions, you always call the show 800-516-1220. Email the show, Tony@BayAreaLoanSource.com, or Facebook, LinkedIn, YouTube. That's Bay Area Loan Source. We'll come back after this break. I'm Tony Mendez in the Real Estate Report.
Phone lines are open on the Real Estate Report. 800-516-1220. That's 800-516-1220.
Welcome back to the Real Estate Report. I'm Tony Mendez. Thanks for joining the show. You can call the show 800-516-1220, 800-516-1220. We actually got a call from Juan in San Leandro. He he didn't quite make it through. By the way, we do have a producer, so if you want to ask a question about mortgages, you have to be channeled through to me. If you want to talk to a producer about radio, then you can call the producer. But Juan wanted to know about, his question was pretty simple. How long will rates stay up? We have no idea. There's a saying in our business that palm readers and psychics have never won the lottery. We don't know. We think that rates are going to stay higher for a period of time. We think through the rest of the year until the Fed starts seeing slower inflation, and they want to see things working. As soon as they do, then they've built some higher rate. They've built in some rate increases in so that they can lower rates. That's what they do. They go up and they go down. We just don't know how long this time. We are all in new territory. I'm not going to say this is the new norm. This is our normal now. Go look at the charts. The rates have been up. They were up for a long time, and then they just kept down, 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 down. Where else were they going to go? They had to go up. When they come back down is really determined on how the economy reacts to inflation right now and the Fed's policy. I think the Fed's been doing, I think, a decent job in being quick and transparent about what they're doing. And I think that's really helping people. Now, okay, forget about the stock market right now for a moment. It kind of stinks. A lot of people have been worried about that. But because, especially as in the normal situation, we see the stock market drop, we'd see rates drop with it. It's about following the money. And we're just not seeing people. We're seeing more people put money into longer term debt than shorter term debt. So we're going to see that happen for a long period of time. I believe long being at least a year. So, but it is going to have a lot of fluctuations. That's why when we see these reports that refinance volume responds to improvement in rates, that means that people are paying attention to the ebbs and flows in rates. So if you are interested in, it's going to be a little harder for a buyer. But for refinances, yeah, you can do that. One thing that you can do that we're proud to say that we offer, and that's what they call a lock and shop. You can do what they on a undetermined property. We call them a TBD, to be determined property. You can lock up to 60 days on a to be determined property. You don't have to have an address. You have 30 days to find a property, but you can lock it. So if you see those ebbs and flows and the rates have dropped and you say, okay, I'm going to lock it in. You got to be registered with the lender and, with us, and you have to have your credit pulled and it qualified, but you can pull the trigger whenever you want. And then, during your shopping process. So they also do, A lot of people are doing these with jumbos as well, TBD jumbo approvals. A lot of people need those because there's some really tight guidelines with jumbos. And the last thing you want to do is get into an offer and then find out, I mean, this is the famous case. There was one person in the peninsula that that was in contract to buy a $1 million house. They made plenty of money. They had plenty of down payment, but on their bank statement, which you have to provide, where the source of your down payment was a deposit from like Hong Kong, and it was just non-traceable, and they lost their deal. They had to go to a different bank, and then they fell off, and they weren't able to get the house. So if you want to get into a loan and you have something, especially if you're self-employed, you have some Schedule C income or 1120S or some sort of corporate, anything that's tricky, you can get a TBD jumbo approval. Those are fantastic. And then you're walking around with something, okay, here's all my conditions. Here's what I need to do in order to get my loan. As long as I can do that, I'll get the loan. As long as the house passes appraisal. So that's another really good thing. These things keep popping up in our industry, and we've been really happy to see how the mortgage side has been enabling the real estate side. And that's why one of the reasons we love doing the show is to keep people involved in this. Again, if you have if you want more information about stuff like this, you can always email me, Tony, at BayAreaLoanSource.com. Again, you can always find more information about this at YouTube, LinkedIn, and Facebook. It's all Bay Area Loan Source. We talked about buy downs. I don't need to do that. Something that has been going on for about, I want to say 15 years is the way that FHA looked at condos. In the years ago, they would look at a condo, a single unit, you're like, oh, I want to buy this, but the whole complex had to be approved. It still does in a way, but they didn't keep it in their single family portfolio. They had it in their commercial portfolio. So now, after years of battling with FHA and HUD, they finally changed the rules. Now you can actually get a single unit approved much quicker and much cheaper, and it involves the whole complex with minimal paperwork, to the point where you can actually do this on a purchase. You get in a contract. You can get the documents filled out by the HOA. You submit it to the lender. They work with FHA to make sure it meets all the requirements. Some of those requirements on a purchase, they're limited to 10% on how many FHA loans in the project. So if it's 100 units, you can only have 10 FHA loans, and most of this stuff is listed at FHA.gov. You can look it up under FHA condo approval. It's right there, and to see if your condo is approved. If it's not, then you have to follow these steps. You have to have 50% owner occupied or more, and you can have no more than 35% of commercial space. So as long as you meet these kind of requirements, FHA has made it a lot easier for that single unit in that building to be approved. And this is important too, as a lot of people are going, oh, that single family house is $800,000. Rates just went up. I don't qualify. But that condo, that's $600,000. And I can afford that, and I want to get in housing. I've been saving money, and that's why I've been saving money. I'm going to buy this house. So a lot more people, I believe, are going to go into condos. In fact, we've seen condos be extremely resilient during these last few years, and one of the largest segments, it is the largest segment of growth in the United States as far as home appreciation, because it's in the affordable range, and that's what people are looking for. So if you are indeed looking for a condo, we can help you with those condo approvals if it's not approved. But again, you can go to just Google FHA condo approval, type in the association name, the state, and maybe an address if you have it, and it'll pop up. It'll tell you if it's approved. Pretty darn easy. If you can't remember that, you can always email me, Tony at BayAreaLoanSource.com. If you can't remember that, you can go to Facebook, LinkedIn, or YouTube at Bay Area Loan Source, or call the show 800-516-1220. Some other news that's out there, housing market update. Asking prices come down from all-time highs. According to Redfin, a record share of home sellers are dropping their prices after a month's historic mortgage rate hike put a damper on home buyer activity. But there are early signs that demand is leveling off. We're going to see more and more of this. This is just the beginning. And that's why we started off the show kind of talking about how to work with sellers and how you can use credits towards whether closing costs or buy downs or points. You have to be have to think about this. You need to know your options. We're here to help you with those options. You can always reach out to us, Tony or Gordon, at BayAreaLoanSource.com, or you can hit our website up, BayAreaLoanSource.com, Facebook, LinkedIn, YouTube, Bay Area Loan Source. We'll come back after this break. I'm Tony Mendez. This is the Real Estate Report on KDOW. You can always call the show 800-516-1220 or email Tony at BayAreaLoanSource.com. We'll come right back after this break.
Questions about real estate? Call the program, 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez. So an economist said we are at the tipping point for home prices. Case-Shiller, their CoreLogic Case-Shiller report showed that in April we had a 20.4 home value increase. That's down from the prior month. So they're saying that it's down 0.2%. And they're saying that slight deceleration occurred because of mortgage rates. Now, I think it's going to be a lot bigger than that. We're still looking at old money, or old data, that is. The Selma Hepp, she's the deputy chief economist at CoreLogic, said that the slowing suggests that we are at a tipping point in terms of home price growth. And that nationwide, the average score soared to a record high in April, marking the 123rd straight month of gains. That's just incredible. 123 months of gains, but expects it to cool to 5.6 by April of 23. So that's still growth. And if you were to take a rent versus buy calculator and use 5.6, not 5.3, 5.6% annual growth, it would tell you to buy every single time, almost every single time, unless your rent is like $500 a month. It would tell you to rent. So we also, there's a chart, we posted that on Facebook. It shows the last few times that we saw interest rates rise, home prices did not dip below zero growth. They only got down to about 4% growth. So yes, we know that double digits have to end, and getting down to 5.6 sounds a lot more reasonable. It sounds a lot more stable. I think it's a lot more predictable. I think it's a lot more palatable. There's nobody who's saying, oh, if you buy this house and put 10% in, or 15%, or even 20.6% in your mortgage, in your rent versus buy calculator, that's going to work. It'll tell you to buy every single time. I would use one or two, or maybe even not even three, but three at the max, and just to be realistic, because you will see times where real estate does dip, and you have to account for that. Just like the stock market, it doesn't always go up, and so it's encouraging to hear that 5.6 is a good target. I like growth. I own real estate, and I'd love to see 5.6 year over year. That's what we used to have, not this double-digit stuff that we've been seeing. That's a little bit aggressive. So I like rent versus buy calculators, but you have to be realistic about it. Err on the side of caution and be very conservative when you're doing those, because this is a big decision that you're making. On a different note, we are seeing a lot more inventory hitting the market. I think we're up to 22% increase on a year-over-year basis. It wasn't too long ago where that was below zero. We were seeing inventory shrinking. So inventory is growing. That means more options. We like options. There were a lot of people, and I remember saying this, it was back 2014, maybe 2015, I was interviewing a realtor, and I asked him, I said, do you think people are a little bit too aggressive with buying houses just to buy a house? They're buying under power lines, or they're buying on corners, busy streets, and they weren't buying them in the best neighborhoods. They were just buying real estate. And he said, oh, no, this real estate's going up. People just want to get in. I didn't like really that mentality, although it paid off for most people who did that. But now we're going to have more options, and I think that's really where you want to pay attention to the more inventory. And I think we're going to even see more inventory as people start saying, I want a better property, because there's a lot of people that don't have those premier properties that are going to say, you know what, this is the top of the market. we're going to sell. It's not quite up to standard. We didn't fix the kitchen, the bathroom, the yard, the siding, the roof. Could be anything on that house. We're going to sell it because somebody's going to buy this thinking, and that's going to create more inventory. So that's going to give you more choice. That's why I also think that we're going to continue seeing more the investors sticking with it because they have a lot of deep pockets. And they are going to get in, whether they flip the property or they turn it into a rental. Both of those look attractive. Both of them. I don't see any slowdown on the investor side at all. I think we're going to continue seeing a lot of heavy purchases with cash. I think we're going to see a lot of properties flipping. I think we're going to see rents stay where they are for a period of time. Yeah, they're going to take a little bit of hit, but right now they're projecting just a slowdown in the growth of rents, not a dip in rents. So I think we're in this, going back to Juan's question, he called in from San Leandro, how long will rates stay up? I think we're going to be in this phase for a while. We are going to see some ebb and flows in rates, but I think that we're going to see, as far as prices and rents, continued growth, just much slower, which is what we need. We need it much, much slower, and inflation is going to be working. It's already working with builders. Builders are seeing a massive decrease in prices of lumber. Lumber prices have dropped considerably, and that's really good news. And what's not good news is that they still have other kind of constraints, supply constraints, and there's a lot of unfinished building that's out there. So there could be another, once those supply issues are fixed, and they might be able to finish these houses, and then all of a sudden there's more inventory, more choices for you. I like choices because if you're going to spend money, you might as well spend money on something that you like instead of something you don't like. That's always been a great philosophy to follow. Buy something that you like and instead of something cheaper that you don't like. Always follow that philosophy. A couple other pieces of, days on the market. We're going to talk a little bit about that. What does it mean to have a days on the market? I don't know if I would. There's a lot of loopholes that you have to be careful of. A lot of realtors will put a house on the market. If it hits 90 days, they'll pull it. In some states, they can kind of refresh that number so it doesn't, take it off for 30 days and then put it back on. So it does not necessarily mean that house is taboo. I would still look at days, houses that have been on the market a little bit longer, but still there's just not enough inventory on the market for you to be overly aggressive. First, like the house. Second, then, get the attraction, get attracted to that buyer or seller, and then start working the numbers from there, and then start looking at all your options, especially with loans. Thanks for joining us today. You can always reach us at Facebook, LinkedIn, YouTube, and Instagram. It's all Bay Area Loan Source. You can go to our website, bayarealoansource.com. You can email me, Tony at Bay Area Loan Source. And I think that's about it. Thanks for joining the show. We will see you next week. And hopefully Gordon enjoyed his vacation and he's got a nice tan on him. We'll come back next week. Thanks.